We fear both the unknown and the unexpected. Retirement brings on both of those emotions, but it doesn't have to be scary if we're prepared to face the biggest retirement fears. I'm Wes Wood, the income guy and founder and president of Wood Financial Group. And for nearly 20 years, I specialize in helping hardworking Tennesseans just like you reach their retirement goals through income-based financial strategies. And if you're looking for the right solutions to achieve your own financial goals, you've come to the right place. Reach me at retiretv.com or by calling 855-776-0614. And today, we're talking about some of your biggest fears heading into retirement. We all know life can be scary, especially in times of change and transition. And one of the biggest changes is retirement. So after decades of working and building a career, you enter a stage of life with new challenges and new opportunities. Your financial security is no longer determined by your job. It's totally up to you. Yes, retirement can be scary, but it's a lot less scary when you know and are prepared for the biggest fears in retirement. And we're going to talk about those fears on today's show and tell you how to prepare for them. We'll focus on 3 of the scariest retirement questions people face. The first one, can I retire? Number 2, can I maximize my Social Security? And number 3, will I be able to meet my health care needs? Also, David Scranton joins us again this week. He's an investing for income specialist with over 30 years in the business. He's also a best-selling author and a TV host. But first, before we get to Dave, let's talk about the first question I mentioned, can I retire? Retirement is always changing and evolving today, especially with baby boomers who are redefining it all over again. They've chosen to be more active and have more unconventional retirements, and many of them continue to work part-time or even full-time jobs. Some go this route because they want to keep working if they're able, but for others, it's a financial choice, or it could be a combination of those factors. But in some cases, it's just a convenient way of avoiding confronting the question, can I retire? By choosing to keep working, you avoid ever discovering if you'll be able to stop working in order to pay your bills. In other words, you deal with the question by just simply avoiding it, which isn't dealing with it at all. And if you really want to keep working or start a second career, go for it. However, you still should take the time to explore this question, can I retire, rather than just completely avoiding it. People who avoid answering the question are usually approaching it with the wrong mindset. They believe that it all boils down to the size of your nest egg. They ask, how much have I managed to save during my working years? And is it enough for me to even retire? These people think more broadly about their bills and their expenses, and they just assume that the answer is no, I can't retire. Well, here's the secret. That's exactly the wrong way to approach this question. Yes, of course, we all know it's important to save as much as we possibly can for retirement. But I want you to keep these 2 things in mind. 1, there's no magic amount that everyone needs to achieve. And 2, for most people, your lump sum total of what you have is less important than having the right allocation that's right for your retirement. And I stress the word your because it's the first thing you need to do is to identify your specific retirement goals. That's one step towards eliminating the biggest fear of retirement, can I retire? Hey, maybe your retirement looks like downsizing. Maybe you want to travel. Maybe you want to buy a boat, perhaps move abroad. Maybe you really want to keep working or perhaps even start a new business. And again, if you do, that's great. But don't assume you just have to because you haven't managed to save $1 million that you think you need in order to retire. In addition to identifying your goals, it's also very important to factor in all the other sources of retirement income. And these sources of retirement income include Social Security, which may be a more important resource than you even realize. And I'm going to talk more about that in just a few minutes. But right now, I want to welcome our guest today, Dave Scranton. A little bit about Dave. He's the founder of Sound Income Strategies and the founder of the Retirement Income Store. Hey, Dave, thanks for being here on today's show.
Great to be back, Wes. I love it. All right, so I know you said the allocations are more important than, the lump sum. And what you mean by that, I know, is that you're talking about the allocation toward income, how much income the portfolios generate can be more important than the lump sum. But if someone wants to back into that lump sum number to determine how much they need in a lump sum to reach an income goal, how do you teach them to do that?
Well, there's good question, Dave, and there's a few different ways to go about doing it. One of the things that we always like to do is help people identify those goals. But one of the other ways that we can look at is to determine how much income they need to have is do what we call a top-down approach when it comes to budgeting for retirement. Meaning, what you want to do is take the amount of money you have while you're working, the top portion, then subtract out some of those expenses that are going to go away when you do retire. Like your 401k contributions, which you're not going to have anymore, your FICA deductions, maybe you're going to pay off your mortgage, that's an expense. Then what you're essentially left over with is a number that's the net amount that you're accustomed to live off of now. And for a lot of people, that may be enough. But the big question is that it's probably not, you probably can't generate enough just from Social Security. It has to come from other sources like your investments. So that's when we need to look at the investments to assure that the allocation is generating enough income to fill that the gap between Social Security and perhaps the need for income that they're going to have.
And the basic rule of thumb there, I believe, that you use is if somebody's perfectly allocated, in other words, allocated toward income, that they can get about 4% income flow as a general rule from a lump sum. So $1 million generates about $40,000 a year to a retiree. Is that about right?
Yeah, no, that's a great rule. Now, the rule of thumb that used to be used for the growth allocation, which quite frankly is the wrong allocation for retirement. It's really more about income now. But the old rule of thumb was 4%. But now that rule's kind of been thrown out due to the last 20 so years of the stock market. But investing for income, we can still use about 4% of the lump sum to generate it through interest and dividends. Absolutely right. So $500,000 gives you $20,000 of income. $1 million gives you $40,000, and so on and so forth. Yes, sir.
And correct me if I'm wrong, but you actually have software in your office that can help stress test people's portfolios. So when people come to see you to see how they're going to do through retirement, it's not like most advisors where you're just planning up to retirement for some lump sum. You help show them throughout maybe a 30-year retirement by stress testing their money so they can feel confident that they're not going to have to unretire in the future, correct?
That's right, or run out of money. And what we do typically in those meetings is gather the information that they have, do a fact pattern, understand how much money they have, then put it into the system to stress test to determine is their allocation right to generate perhaps the 4% income that they need, or we can determine what kind of income that they want to take from the portfolio and stress test it with this software in order to determine if they are going to be allocated properly.
Good stuff.
Yep, that's right. But hey, David, don't go away. We're going to talk more later in the show. But coming up after the break, we're going to talk about Social Security and how you can make sure you're maximizing your benefits. We'll be right back.
Retirement accounts like 401ks and IRAs are great tools to save for retirement. They offer tax advantages to help keep more money in your pocket. But withdrawing money from your accounts can have a huge impact on your tax liability. Take money from the right account at the right time and you could minimize it. But taking money from the wrong account at the wrong time could result in a big tax burden. If you're not sure what you should do with your 401k in retirement, visit retiretv.com to schedule a free, no-obligation conversation with Wes Wood and Wood Financial Group.
I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're 55 or older, please claim our free Retirement Income Kit, chock full of information you need to know to get steady income during your retirement. Call 866-714-7377, online at theretirementincomestore.com.
Welcome back to the Retirement Income Show. I'm your host, Wes Wood, and today we're talking about you facing your biggest retirement fears. We talked about the first fear many people have, and that's answering the question, can I retire? Now let's talk about another scary retirement question. can I maximize Social Security? You know, Social Security is supposed to be a source of comfort. But as you approach or enter into retirement, scary questions begin to emerge. Questions like, is Social Security even going to be there for me? Will I know the right time to start taking my benefits? How is Social Security going to affect my income taxes? And will I get the most out of Social Security that I'm entitled to? Let's begin with the first question. Will Social Security be there for you? Well, the short answer is yes. The long-term answer is probably, because it's true that the ratio of retired baby boomers to younger workers has definitely put a strain on the Social Security Trust Fund in recent years especially. But it's also true that the fund is still operating at a surplus, a small surplus, but a surplus. And at this point, there's enough reserves to be able to pay 100% of your promised benefits through the year 2034. But after that, benefit reductions are going to be necessary unless Congress acts to fix the program. But there's already some bills that Congress is talking about aimed at doing just that, restoring the solvency of the system. And it's highly likely one of these will pass. But even if one does pass, and you do get 100% of your payouts from Social Security, most people come to realize is that Social Security isn't enough income for you to really retire on comfortably. That's why it's so important to consider benefits in relation to other sources and all sources of your retirement income. Your sources like 401ks, IRAs, pensions, and of course, employment income if you do plan on continuing to work some while you're somewhat retired. When you factor in all these things together, you realize Social Security can actually serve as a model for your whole retirement strategy. Why is it a model? Because it's a secure source of income you can depend on for your life. And the trick is to allocate your other assets in the same way that makes them the same thing, secure sources of income that you cannot outlive. And the same thing is true, you must get the most you can from Social Security. And we can help you with that at my company, Wood Financial Group. Visit me at retiretv.com and get your free personalized Social Security analysis. You can also give us a call anytime at 855-776-0614 and request your Social Security analysis. Now that leads us to the next scary question about retirement. When is the best time to start collecting your Social Security? You probably already know this, but you can begin anywhere between the age of 62 and 70 years old. And typically, the longer you wait, the more that you're going to get. But it's not that simple at all. That question, the answer to that question depends on several different factors unique to your own situation. Factors like, what's your health status, your marital status, life expectancy, what are your goals in retirement, and again, all your other sources of retirement income. So the best way to analyze all those different factors and get the right answer, how do you do this? The best way to do it is you want to work with an advisor, a financial advisor who specializes in retirement income. Because what they can do is help you figure out not only the best time for you to start taking Social Security, but how to maximize your benefits in every possible way. And we can help you maximize your Social Security benefits with your personalized analysis. Visit me at retiretv.com to request yours, or give me a call at 855-776-0614 anytime to request your personalized Social Security analysis. Now let's bring back my guest, David Scranton. Hey Dave, thanks for sticking around and joining us.
Of course. So I get it. If you're single, it could be complicated enough because you have to factor in your personal income needs when you retire, your own expected longevity based upon your current health, which is, there's always a guess factor there, of course, right? As well as longevity of family members. But that gets exponentially more difficult, at least the decision as to how to maximize those benefits when you're married, correct?
You got that right. I mean, when somebody is single and has generally an idea about how long they're going to live, determining which is the best way to take Social Security becomes much more simple. But when somebody's married, we need to include factors like spousal benefits and even survivor benefits, because especially if there's a difference in ages between spouses, because it's not just about me, it's also about my wife. And it's not just about her, it's also about me. So we need to coordinate our benefits to get the very most for our family and for whichever one of us happen to live a lot longer.
Now, is that why you've told me in the past that I personally should wait till age 70 before I take Social Security?
That's right. I'm glad you were listening, Dave, because you and Teresa, there's quite the age difference there. You definitely robbed the cradle, and one way to get much more benefits from her in the event that you pass away is because you're going to get more Social Security benefits. But when you pass away, she's going to get the greater of the two amounts. So in that event, it makes more sense for you to wait to make sure she gets maximum income from Social Security during her lifetime as well.
Makes sense. Rob the cradle, heck, there's only 7 years difference, Wes. Come on. I'm in southern Florida. The average age difference is usually 20 years between spouses down where we are.
Well, it's a little different down there. That's right.
One of the things that I find that's most confusing to people when you're talking about Social Security is they get confused between determining when they might be subject to a reduction of benefits versus when they might be subject to a taxation of benefits. So do you care to clarify that a little bit?
Yes, that's definitely confusion. There's two completely separate things. Reduction in benefits has to do if you take Social Security before your full retirement age, and if you make too much in the form of wages, earned income, work income that you get from having a job and getting a paycheck. It's not seeing a reduction in benefits from unearned income like distributions from retirement accounts, for instance, or pensions or rental income, which is deemed unearned income. That's reduction in benefits, called the annual earnings test. However, taxation of benefits is totally different, where you'll have to pay perhaps more income taxes on your Social Security if you just have too much, if you have a certain amount of income, adjusted gross income that goes over certain things like provisional income threshold, which is a little more complicated than we want to jump in today, but they are definitely two different things.
And that's part of the reason why you have sophisticated software that you've invested in your office, where you said a moment ago people want to call your office to learn how to maximize their Social Security. In fact, I think you have Rachel in charge of that, if I remember correctly. Yep. That's really who's really your dedicated Social Security specialist.
That's correct, and we've already probably spent thousands of dollars on this software, so I'm always encouraging clients that, hey, you don't need to go spend thousands of dollars to run this software one time. Work with an income specialist, work with us, we can run it for you for no cost and tell you, out of all the different rules and combinations, which ones to choose to get the very most from the Social Security Administration. But yeah, thank you, Dave, and hey, coming back after the break, we're going to tackle another big retirement fear, and that's the rising cost of health care. Stay tuned, we'll be right back. Welcome back to the Retirement Income Show. I'm your host, Wes Wood, and today we're talking about facing your biggest retirement fears. And one of those fears is rising cost of health care. We all look forward to a long and healthy retirement, but the fact is, and you know it, the older you get, the greater the chances of you having to deal with a major medical event. And not only that, but just as you're trying to stay healthy as you're aging, things cost more. Medical expenses cost more doctor's visits, more medical procedures, more prescription drugs, and the list goes on and on and on and on. And it's not surprising then that another one of the scariest retirement questions for most people is, will I be able to have enough money to cover my healthcare expenses? And it's for sure a legitimate concern. An unexpected major medical event is one of the most common causes of financial problems for retirees, even those with excellent health insurance. A serious health issue can result in hundreds of thousands of dollars in bills. And to make matters worse, healthcare costs increase at a faster and steeper rate than the general rate of inflation. If you look at inflation, in the last 18 years, it's grown on average of 2.2%. But by comparison, healthcare inflation has been running at 5%. That's over 100% more higher than the general rate of inflation. Give you a little illustration on why that could be so scary. The current average cost of full-time in-home nursing care is somewhere between $150,000 and $200,000 each year. And if we look at it at a 5% inflation rate, that means in 20 to 30 years, that cost may have risen between $400,000 to $550,000 in 1 year. And once again, even with good insurance and large savings, those kinds of costs can be devastating and disastrous if you're not properly prepared for them. And even if you think you're prepared, you might not still be if you're still investing for growth instead of investing for income. For example, let's say right now you have $2 million in your IRA. With that, you're thinking, hey, that can cover in-home nursing care for probably 10 years. But if your investment allocation isn't geared towards income but still in growth, you may not really have that $2 million waiting on you. That's because when you hit 72 years old, you're forced to take a required minimum distribution. And if your strategy is still based on growth and capital gains instead of income, there's a good chance you'll end up satisfying your RMDs by spending down and liquidating your principal, which can be a very slippery slope. And as a result, by the time you need in-home nursing care, your IRA balance may be down to, say, $600,000. And then once you factor in that 5% healthcare inflation, that 10 years of care you thought you could afford today may only be down to 1 to 2 years by the time you actually need it. And again, all that is scary stuff. So how do you eliminate this common fear? Well, once again, an advisor who specializes in retirement income can help make sure that you have a plan that factors in all these scary contingencies. A plan that helps you avoid common costly mistakes associated with healthcare costs, including spending down your principal. You know, you can get started today, right now, by contacting me at retiretv.com or by calling 855-776-0614. Now, let's welcome back David Scranton for one last time. Welcome back, Dave.
Well, thank you, Wes. I'm going to ask you a personal question. I hope you don't mind. When you go into studio there for the show, do they make you wear makeup?
They do not make me wear makeup, Dave.
They
no.
do not?
No.
Darn, now I'm jealous. You're
Right.
that good looking without makeup.
You think I look that good, huh? Well, thank you.
I
Dave.
know, absolutely.
I'm flattered.
So tell me, explain please how investing for income actually helps protect you when it comes to long-term care costs. You touched upon it, but can you go a little further?
Yeah, absolutely. Anytime you give me a compliment like that, I'll be happy to answer your questions. But yeah, so looking at using your money to pay for long-term care is something that a lot of people kind of forget about. That money needs to be there in the future for you to pay for that expense. Nobody wants to be in a situation where they have very little savings later on in life and they spend down their money very quickly due to long-term care, and they have to depend on things like Medicaid or family to care for them at that point. So we need to think about it early in retirement, meaning we really don't want to spend down hardly any principal, if very possible, early in retirement. It's okay to do it when you're 85 or 90, but if we have the right allocation early in retirement and we're generating enough in the form of interest and dividends to cover our income needs, to cover required distributions, then we can sustain the principal longer. Eventually, the government is going to force us to take out more than our interest and dividends because RMDs do go up every year, but at least we can extend that later on in life. And what that does is it gives us more money down the road to pay for that long-term care expense, so we can essentially help kind of self-insure that need.
So basically you're saying keep the principal intact as long as you can, because at an older age, if you need it to stay in the comfort of your home, then you have it. In a nutshell?
It's just like running out of money in retirement. If you start spending down your principal early, it doesn't seem like much, but it really adds up over time. Good analogy, a 30-year mortgage. Think about it this way. On a 30-year mortgage, you pay the exact same every single month, right, for 30 years. Well, the first few years of that mortgage, you're paying like all interest with just a little bit of principal. But at the end of that mortgage, you're still making the same payment, but now you're paying all principal with just a little bit of interest, and it's paid off. Well, it happens in reverse when you're taking money out of a portfolio, especially when you're taking out principal at the beginning. You got this big, mound of money. You're taking out a lot of interest at the beginning with just a little bit of principal. But towards the end, it's a lot of principal with very little interest, and people are running out of money. And really, we need to try to keep that principal intact for as long as possible.
Yeah, spending principal could be like the silent killer. You know, it's a little bit now makes a big difference long term. And I'm sure your clients are not that much different from mine. And I know in my experience, I've never had one single person when we were establishing their retirement goals who said, my goal is to live in a convalescent home at some point in my life, right?
I have not heard that one of the thousands of people that I've talked to. That's right.
That's right, never at all. And in younger years, at the beginning of retirement, is the biggest cost seems to be prescription drugs, correct?
Definitely. That's where a lot of people are spending a ton of money in retirement, is just on those prescription drugs. Yep.
In the earlier years, yeah. And now you have contacts, you have relationships because you want to be a holistic, you're a holistic financial advisor. So you have people that you can refer your clients to when they need help with Medicare supplements, they need help with long-term care insurance. So you can help them overall, correct?
Absolutely. I mean, we kind of look at ourselves as retirement advisors, people that help retirees. So we need to have that under our roof, or at least have an ability to get our clients to the right people to make sure that they're well protected. But Dave, I want to say thank you for joining our show today. I'm Wes Wood, the income guy. A big thank you to Davis Grant for joining me today, and a big thank you for watching. If you have any questions about anything we've covered today, please reach out to me at retiretv.com or by calling 855-776-0614. So long, and be sure to tune in again next week. Hi, I'm Wesley Wood, host of the Retirement Income Show, and I'm founder and president of Wood Financial Group. And we're a local independent financial services company that specializes in creating custom retirement solutions tailored to meet your particular needs.
Visit retiretv.com to learn how we can help you create a customized retirement portfolio.